To help us talk about and think about 2014, I've got Ridham Desai, who's the Managing Director at Morgan Stanley Research here with me. Ridham, thanks very much for your time. Great to have you. I've got your report here. It says 2014, winner takes all. And I'm going to just, read out the first line. You say the market call in 2014 is more challenging for us than we can remember in a while. Why is that, Ridham?
I think because there are a set of known unknowns, and predicting how those factors will pan out, I think is going to be quite difficult. So I think the economy is probably in a troughing stage. I don't think it has actually started to recover. So corporate profits are probably going to languish for the next 2-3 quarters. The market will have to be forward-looking in order to actually make gains. And then we have two very big events. We have what the Fed will do, therefore what US data will do, and then what will happen in the elections, which will dominate proceedings in the first half. And in the second half of the year, we have to foretell what policy actions the government will take, because ultimately the economy is in bad shape and it requires a set of policy fixes. It's very difficult to tell in advance how that's going to actually pan out. We can list out the policy initiatives that are required, but we really can't tell which ones will be chosen by the incoming government, and therefore how quickly growth will come back in, say, 2015. So I think the market will do these yo-yos like it has done in 2013. And indeed, even though 2013 at this point in time appears to be a good year because we have reached an all-time high, the fact is that net-net from the beginning of the year to now, equities are up only 8%. So you still lost money in real terms, you still underperform fixed deposits, you still underperform bonds. So it's not been such a good year, and it's hard to imagine that we get back-to-back years of such kind, but I think the outcomes could be actually extreme, which is why winner takes all. Which is either you get into a raging bull market because everything goes right for India, or you actually see a big down year because things don't go so right for India. So I think these are the two outcomes. So there are extreme outcomes, and in fact our base case scenario, which is that the market doesn't do a lot, doesn't carry a probability which is significantly greater than the one that you generate out of a toss of a coin. So essentially I'm expressing my inability to make a central forecast, and I think we're going to rely on these bull and bear case scenarios and probably evolve that as the time passes and as events unfold.
Yeah. But yearly forecasts are anyway tough to make, right? In any year, they're pretty tough to make.
Yeah,
I mean, if you go back into what was said at the start of the year and then go back and look at how the year has performed, I mean, in most years there'd be a wide.
Yeah, we usually get it wrong. We don't get it right. Equities are a long-term asset class.
Yeah.
They're not supposed to generate returns on a yearly basis.
From Jan to December.
Yeah, that's what fixed deposits do for you. If you put money into a fixed deposit in January, you know precisely what you will make at the end of the year. Equities actually make money over the long run. They are a long duration asset class, the longest duration asset class in the world. And therefore, investors with a 3 to 5 year horizon usually come out good in equities. Those with shorter term horizons, I think, tend to actually suffer more than gain, even though in short periods of time and on occasions they seem to make outsized returns, but those then whittle away when the next short period arises. So you're absolutely spot on. The emphasis is not on actually forecasting the market. The emphasis is in laying down the framework. And the framework really revolves around what will create the next bull market, or what will create the next stage of the market, bull or bear as the case may be. And I think in India the framework revolves around two things. One is the cost of capital, because the cost of capital is going up for India. And the reason why that is happening is because India has run up a large savings deficit over the last 4 or 5 years. And hence it has started importing savings, what you ordinarily call as the current account deficit. And therefore its cost of capital now hinges on what happens to the cost of capital of the world's reserve currency, i.e. the US dollar. Now because US growth is coming out of a downturn, the cost of capital in America arguably is rising. That's lifting the cost of capital in India, which for India turns out to be pro-cyclical tightening, because we are actually still not out of the woods in terms of growth, and it is the wrong time for us to actually experience a rise in the cost of capital.
Right.
So it actually increases our challenges. So that's one part of the equation. The second part is what we need to do, the idiosyncratic stuff that we need to achieve. So two things are there.
I mean,
One
fixing local inflation and things like that, right?
No,
I mean,
well, I would say first is relating to the first point, which is that the savings rate has declined.
Sure.
So you have to lift the savings rate in the economy. The second and most strikingly is that the productivity of capital in India has halved and is now at an all-time low.
Right.
So that needs to be fixed, because unless you fix that, the investments that we are actually making, and by the way, the investment rate is still very high in India relative to the rest of the world, is not generating the output growth that it ordinarily generates, because the productivity of capital has fallen. So we can dwell in these 2 points, but these are the 2 things that India needs to do, and India is faced with the challenge of rising cost of capital from the rest of the world. So it makes it particularly difficult for an asset class like equity, and how these things evolve will decide how the next 3 years for equities pan out.
Sure. You know, so just to go back to what you said, you highlighted 3 things: Fed, elections, policy, response here locally, right? So in a nutshell, you seem to be saying that, well, and this may seem jaded, the market in 2013, to me at least, has climbed the wall of worry. It has actually, right? Everything that could go wrong was supposed to go wrong. Some did go wrong, some didn't. It was yo-yo. We ended positive. Many sectors did very well. 2014 also doesn't look like many things can go right. Many things can go wrong, but I don't think many things can go spectacularly right in that sense. I mean, taper will happen at some point, right? Some of the policy issues won't get resolved in the next 12 months. I mean, it'll take longer. Elections, well, it's anybody's guess. So there are more risks than you know, ideally what you'd like to see in a year. Would you agree with that? And hence, to say that, and many do, that market will take off, we'll see a parabolic move, we'll get into a new bull market, things like that. I mean, does it seem possible?
I think for the bulls, the caution is that the challenges are a little bit more intense than they appear on the face of it. So it is not about nailing the election result. I call that as a necessary but not sufficient condition to fix India's problem. So certainly India needs effective leadership, and that is an issue that the election can resolve, which is that it can produce a strong, stable government that can take decisions to fix India. Then the next step, and the more difficult step, is to take those decisions, is to actually roll out policy. And time will be required for those policies to take effect on the economy. So the healing, I think, will be slower than what we are second guessing right now. Okay? So that is the challenge or the caution for the bulls. The caution for the bears is that a lot of these are known, right?
Yeah.
I mean, everybody can spell these things out. So there's nothing out here that seems to be less than known, which is, we know that the US economy is recovering. We know that, you know, bond yields in America are going to rise. We know that taper is only a matter of time. Jan, Feb, March, you can put your date and it'll come. So I think a lot of those things are known. Also what is known is that we have an election event. Also what is known is that the government needs to do some policies. So the challenge for the bears, and you know, for somebody to get too bearish on equities saying that you know, this is not going to work out well and you know, we should be out of equities, is this. What I try to do actually is not try and predict the outcomes, because predicting outcomes is a mug's game, okay, and they are not very easy to do. What I think you should focus on is what's in the price. So I think when you
what's in the price?
Yeah.
Right
So
now?
what's in the price? So basically, what are equities telling us about what will happen to each of these events? So more recently, I think the market has got a bit more exuberant about the election outcome, say for example.
Right.
So obviously it is now pricing in a more positive election outcome than it was, say, 6 months ago. 6 months ago, it made sense to take a call on the election outcome and say India will produce a polarized election outcome, which is in fact what we've been arguing for 9 months. Now it makes less sense to argue in that camp, because the market is already arguing for it, right? 3 months ago, the market was terribly worried about Fed taper and obviously sold off very hard. And therefore it made sense to argue the other way around, that the Fed may actually reconsider or may actually do this,
but that's
or it's priced in.
That's not the main view.
Yeah, so I think what's priced in right now, in my view, is that the market is thinking that we are on a growth recovery path. And the reason I'm saying is that when you look at the difference between the equity yield and the bond yield, bonds are far more compelling. Okay, so the equity yield in the market is about 6%. Or 6.5%. The bond yield is at circa 9%. Bond yield is far more compelling. That gap between equity and bond yield, which is close to 300 basis points, is a lot of growth premium that markets are ascribing to equities, which means that the market thinks that the growth cycle has turned. And to me, that is the central risk to the market. Not the election outcome, not the Fed, but precisely what happens to growth. And you have to evaluate the prospects of a growth cycle turn in the next 4 to 8 quarters. And if you get reasonably assured that growth is turning, then I think you want to buy equities. Otherwise, you want to actually wait for a better time when the market is pricing in less optimism about growth.
Let's just talk stocks and sectors, Ridham. So where do you see absolute returns? I mean, the biggest absolute returns as we head into 2014.
So our approach is to buy growth at a reasonable price.
Right.
We don't want to chase beta, leverage, and capex as of now. Those are late bull market cycle approaches. At the nascent stage of a bull market, if we are in one, you still want to buy growth. If you're not in a bull market, you still want to buy growth. At a reasonable price. We're always very conscious of the price that we pay for growth. So
but you write here that valuations are not low, right? We're not starting at low valuations.
For the?
I mean, generally, for the market as such.
Yeah, but individual stocks on a bottom-up basis, there are ample opportunities.
Okay.
If you convert that into sectoral views, I think I'm still reticent to actually be buying too many banks.
Okay.
I think the private sector banks are okay selectively, but on the aggregate, banks are still in trouble, and they will struggle to generate growth next year.
Okay.
Barring a few private sector banks. I think technology will be a great space.
Okay.
This could well turn out to be a multi-year story for tech, because US capex spending is going up, and private capex in America, I think, augurs well for tech spending for Indian companies. And therefore, if you look at technology revenues in India, they lag US GDP growth by 2 quarters. And if US GDP growth is going up, technology revenues will also go up. So share prices of tech companies, I think, should do well.
Even after the phenomenal rise they've had.
Yeah,
I mean,
and this is less to do with the rupee.
Right.
By the way, the INR is not correlated as much with the tech stocks when US GDP growth is rising. It only correlates when there is lack of growth in America. When American growth is good, it doesn't matter really what the
But both things haven't happened together, I guess, at least in the last 10, 12 years, right? A very weak rupee and expectations of stronger growth.
It's logical, right?
Yeah.
I mean, it doesn't happen. But US growth is recovering, and I think that will help technology.
Okay.
So these are the two big sector calls that I would
private banks and techs.
Yeah. Otherwise, I think you want to be selective across sectors. So we are not really we're agnostic to cyclicals versus defensive. We're not making any major choices in terms of buying quality and non-quality, as you may choose to define it. What we're interested in is good businesses at reasonable valuations, and there are a plethora of them in India. I think that's the charm of actually investing in India, which is that you have these set of companies that tend to overcome macro challenges and deliver good growth. And if those stocks are trading at reasonable valuations, whether it's in telecoms, whether it's in energy or materials or consumer discretionary or consumer staples, I think you actually end up making good money on those stocks. So this is a market for those type of, that type of stock picking.
But it's not time to be risky, right, in that sense, because many argue that you could buy very beaten down businesses which actually do have problems and balance sheets are broken, but with expectations of growth coming and the tailwind of a very strong leadership, the capex cycle will recover, and hence, this is the time because they will do very well.
No, I'm not in the camp of buying broken balance sheets.
Right.
I think broken balance sheets have a spot or two in a portfolio, cannot dominate your portfolio strategy.
Right.
is very risky.
Right.
So if you are looking at broken balance sheets and you find one or two interesting names, you can always stuff them in your 20 stock portfolio.
Yeah.
If you go wrong, you don't pay a heavy price for it. But you can't have 10 of them.
Sure.
In a
So 17, 18 of them have to be high. So quality really is the focus. I mean.
No, quality. In fact, I would not emphasize quality as much as I would emphasize predictable growth.
Okay.
Okay, reasonable, predictable growth. So I should have some confidence in growth because, you know, as I said at the outset, the debate here is whether growth is coming back or not. And if that is the debate, then predicting growth is going to be your biggest challenge for the next 2 years. And therefore, if you can predict growth for any particular business, I think you've got it. Then even if you're paying a couple of points higher in terms of P/E ratio, you'll be okay.
Right.
So far as you can predict that. And if you're going to ride on businesses where you can't predict the growth, even if you're buying them cheap, it will be then dependent on the macro trade, which is that you will have to get the macro trade right in order to make money on the stock. I'm still not willing to do that.